Hi, everyone, and welcome to today's webinar. It's how to assess your managed funds and choose the next one. I'm Tom Wilson. I'm the Investor Education Specialist at InvestSMART, and I'm joined by Mitchell Sneddon, our Head of Portfolio Services. And we'll get straight underway, just so as we can run through a couple of things. Just always the disclaimer as well, we provide general product advice only, not any type of personal financial advice. And as some of you have probably noticed, you can comment on the program itself. If you're watching this on YouTube, you can also comment, and we can display your comments on the screen and answer them as we go. So we'll run through a number of different slides. Definitely reach out to us as we go through, because it is interactive, and there'll be a copy of this uploaded after we answer the door. So sorry about that. So that's the doorbell. But let's get started. Mitch, thanks so much for joining us.
Thanks, Tom. And that's completely thrown me. You don't expect the doorbell to be going off at the office to start a webinar. So what Tom and I, what you're all here for today is a presentation based off the recent emails that we've sent out, and our Compare Your Funds webpage that you've been going to. And of course, part of that webpage, you might have seen these large, the big scary numbers. So from our calculations, 74% of funds return less than the industry standard benchmark. So basically what we're saying there is 74% of the funds out there, if they're benchmarked against the ASX 200 or the MSCI All World Index, they underperform that particular benchmark with their own returns.
Is it fair to say that they're not doing what they're supposed to do?
Well, essentially, if their job is to exceed that benchmark, that's very, very fair to say.
Yeah.
Now, historically, and this number's blown out a little bit, the average underperformance is now 2.53% per annum.
Yep.
For that group. And the average fee charged by these funds is 1.54. Last time we actually did these numbers a few years ago, that underperformance number was much closer to the average fee charge, which is what you'd expect. So the funds have actually gotten worse.
Okay. Yeah.
So these are the big numbers that investors face. These are, I'd say, to a lot of investors as well. They're probably not surprising. I know a lot of people, reach out to us because they're disappointed in their fund performance. They look to go into alternative options and speak to us about ETFs as well, which is something that we're going to speak to a lot about today. So they're just the big numbers that you've been seeing on our website and in our email series that we've been doing recently. Let's jump to the next slide now. I don't want to dwell too much on those numbers. This session today is definitely a bit more about what you can actually do about it if you do find yourself into an underperforming fund, and what to look for in the future. So let's just have a quick look, though, at why those numbers are what they are. So the big one, and the one that we focus on a lot here, is fees. So when you're looking at benchmarks, so the benchmark could be the ASX, the S&P and ASX 200, so the 200 largest companies here in Australia. That's a typical benchmark for Australian funds to be measured against. The MSCI All World is another typical industry benchmark, and that is what a lot of international funds are judged against. So these benchmarks don't actually have any fees, because they are a list of stocks put together by people like Standard & Poor's, who provide these benchmarking services. So there's no fees. So immediately, if your fund is, say, a 1% per annum management fee, a 2% per annum management fee, then that fee is coming out of your fund. So you're already that 1% behind the benchmark, no matter what the fund does. So then there's career risk as well. So what career risk is, is running these funds. You've got analysts and fund managers, if you want to achieve a better result than the benchmark, you need to essentially do something different from the benchmark. You're not going to beat the ASX 200 if you're copying it, and following it, right?
Following it and paying fees.
Yeah. So career risk is when analysts say, they go out on a limb and they might handpick, particular companies, go overweight in those particular companies and get it wrong. So there's actually safety in the crowd. So believe it or not, so it's okay to be wrong when everyone else is wrong. It's just not okay to be wrong on your own. So there is actually career risk. So you can actually people don't want to actually stand out and put their heads on the chopping block. There's size as well. So funds underperform because the bigger a fund gets, the harder it is to actually manage. Because say a lot of the performers are small companies or medium-sized companies. It's very difficult for large fund managers to deploy meaningful amounts of capital into those funds. So you see, generally, the bigger the fund gets in size, the closer it will start to hug the index or the benchmark. Finally, and I actually have thought of one more whilst we were doing this, but finally, I've got a note there that investing's really hard. If you talk to good fund managers, the ones that do actually tend to outperform, they will tell you that if they get 60% of their stock calls right, then they're having a really, really good year. So investing is incredibly difficult when you're trying to pick individual companies or individual assets to try and outperform. Now, the other one that I did just think of, and this would go for a lot of those funds with quite high fees, is legacy. So historically, some people's only access to investing in Australian shares and things like that were these old funds that are still exist today, and they charge quite large fees, 2%. They haven't altered or updated those. So there's that as well. So, but I don't want to, as I said, I don't want to dwell on it. But what we'll do is quickly take a look now at at one of the fund comparison charts that a lot of people might have been seeing recently when they took a look at our Compare Your Funds page.
And I was going to say, we are getting the questions coming through, and there's some really good, juicy ones there, and there's no such thing as a stupid question. So we'll definitely cover some of those probably a little bit before the end, just so we can get through some of the slides. But they're great questions. Thank you.
Yeah. So what we'll do is I'll continue on, but I'll let Tom pick and choose a few questions that we can cover off a little bit later. So this fund comparison page that I've got up currently. So this is if you had gone through our fund comparison tool, and if you haven't, I highly recommend doing so. I've got a fund here, and I was going to blur out the name, but I ran out of time. But anyway, so we've got an underperforming fund here. The fund is is in blue. The benchmark is in green, and the peers, so that's everyone else who is benchmarked against the same industry standard benchmark, is in black. Where InvestSMART does have a comparable investment product, we will appear in orange. So you can see where we don't have 10-year numbers, we have 5-year numbers for our particular portfolio in this space. It happens to be international equities. But next year, actually, we will have our 10-year numbers up. So you can see here, though, this particular fund that we've got up here, and we haven't chosen this one for any particular reason, not to pick on it or whatnot, just because it was the first example that came to my mind. You can see here, this fund, if you do hold it in your InvestSMART portfolio manager, it'll be coming up with a little tag next to it to review your fund. It has underperformed the industry standard benchmark and its peer group, so the average of its peers, over 10 years, 5 years, 3 years, so basically every single time frame possible. So it does, when you are here on this page on our website, the Compare Your Fund page, it will also then show you all of the fees that this fund does charge as well, and the average fees charged by the peer group. So you'll be able to do a bit of a deep dive into that. Now, let's jump on to the next slide. Okay, so as I said, I wanted this session to be a bit more constructive and be more about what you can do rather than hammering on about fund A, B, and C not being the best performer out there. So if you do find yourself with a fund that isn't performing as you'd like or as you'd expect it, the very first thing we did, I spoke to actually a financial advisor recently, Bruce Bremmel, who used to help us out a lot with Eureka Report. And I said, Bruce, what do you do when you're reviewing a client's portfolio and they have an underperforming fund in there, or a fund that you're not happy with the performance? And so he said the very first thing he gets them to do is to actually contact, or either he does on their behalf or gets them to do, is contact the actual fund manager or the unit registry,
yep,
and ask for their CGT position. And that's because one of the main kind of handbrakes to people from actually making a move or looking to sell down a position, a fund, and move elsewhere, is they might have held it for 5, 10, 15, 20 years, and they are handcuffed by the CGT position. So the first thing he gets them to do is actually understand and find out what their CGT position is, because especially if they've been in an underperformer, it might not be might not actually be nearly all as bad as they expect. So that's the very first thing. Find out where you actually stand. The next thing he then looks for is comparable assets. So look for options to move to that have actual comparable assets. There's no use jumping out of say an international fund, for example, or an Australian equity fund into a property fund. If you should be looking to replace a like for like, because you're going to be leaving a hole in your portfolio. The next thing, when you've done that scan, is to compare the fees. Now, if you've read the Alan Kohler article on our website recently, fees are really, really important, and we'll jump into this again because basically you cannot predict the future. You don't know how well the fund is going to perform. The only thing you can predict is the size of the fee that they're going to charge you. So that's absolutely certain. But tomorrow's return is never guaranteed. So, and our data historically always shows us that, generally speaking, the higher the fee, the worse the underperformance of the fund. Now, then the final step. This is once again after talking with Bruce. Then you would look to switch. So after you've figured out your CGT position, you've found the comparable asset class, you've compared the costs, you then look to actually switch out of that, which would be selling down and putting in a redemption into your fund, and then reallocating those funds. Now, I understand that can be a big decision for a lot of people, and a lot of people might want to wait and see, etc. But so instead of something that people can do, and this is the good thing with investing, it's not all or nothing. You can own multiple. You can maybe take your time to switch across. You can drip feed new funds into a new investment option. You can just allocate the dividends and distributions that fund is paying into your new investment option. It doesn't have to be a wholesale change, but at least you've gone through this process. You know where you stand. You know how your fund's performing. You know what the fees cost, etc. So you're in a good position to eventually move.
So essentially, it's a case of doing a bit of research, sitting down. If you need to speak to experts,
yeah, absolutely. If
definitely.
You want to speak to a financial advisor, we certainly highly recommend going and do that.
Tax advisor.
But at the very, very least, do these few steps. and know where you stand, because there are literally thousands of funds. There's hundreds of ETFs available on the market. There's people like us who put together portfolios of ETFs. So there's this day and age no excuse for staying put.
Yep. Excellent. And there's a lot more questions coming through that we'll cover off just towards the end, and some really good ones there too. So thanks for being patient.
Okay. So what I often like to do when looking at a problem or looking at a new investment is often think about what not to do when looking for a new fund. And so I've got you'll see actually I've scattered some John or Jack Bogle quotes throughout here. We're going to lean pretty heavily on his work today. John or Jack, I don't know why they use the name interchangeable, but they often do.
Sometimes Jim, if he wants to.
No,
Just kidding.
It's always John or Jack. Bogle. He invented the ETF. He founded Vanguard, invented the ETF. Hence why his work is going to feature predominantly in what we do and throughout this particular webinar. So I've got a quote there from him. So the biggest mistake we find people make when they come along to the InvestSMART website, or just when they go along to a managed fund search kind of platform where they can sift through lots and lots of managed funds, like Morningstar, for example, which is where all of our data feeds come from. The first thing, and I'm very much guilty of this, what people do is literally get the funds, and then they filter them highest to lowest performance figures.
Yep.
And what I've got up here is a table showing you that that's actually picking today's highest performers is actually probably the way to guarantee that you're going to underperform in the future. So this report, this table, this data comes from the SPIVA report. Now, the SPIVA report is from S&P Global. So, the people who put together indices like the S&P 200, the ASX 200, I should say. And they've done, and this is going back a couple of years now, but the SPIVA report that they do, they release it, I think it's each year, the end of year scorecard. It shows you a couple of different categories of funds here. So we've got the Australian Equity General. So that's your large cap. They've got middle and small cap. They've got international. They've got bonds, and then they've got Australian A-REITs, which are real estate investment trusts. So they've got then they show you the fund count. So how many? We'll just take the Australian Equity General category there. So they were looking at the top quartile funds. There were 80 of them at the start of December 2020. Come December 2021, 37% remained in that top quartile. Come December 22, so just 2 short years after these numbers, only 6.25% of those funds remained in those top quartile performers. So it gets even worse as you scroll down. The mid and small cap, almost zero, essentially. Funds remained in the top quartile. So if you're only looking at funds by ranking them via performance, the SPIVA reports actually suggest if you're doing that, you should look for the poorest performers, because they're more likely to end up in the top quartile than the highest performers. So that's one of the worst things. And if you're going to take anything away from today's webinar not to do in the future, it's ordering these funds by biggest performers to lowest performers, and jumping on board those. I know on our website we actually have basically every managed fund available to people in Australia. On the Eureka Report website, they have a section called Top Performing Funds, and we'd actually often get calls from people wanting to invest in those funds, calling us, and basically almost without fail, those top performing funds would be next year's worst performers. And the reason for that is they might have been in a very specific asset class, or might be investing in a very specific sector, or that got really, really hot one year and just popped.
Yep.
And, I remember a fund last year that was up about 80%. And then from that peak, it was down about 70%. So let's hope the people that were getting in touch with us regarding that fund didn't actually jump in. But so that just shows you that's the number one thing not to do. So what we would recommend to do is focus on costs. So as John Bogle says here, fees compound as well. And so if we're thinking about, our very first slide, the average underperformance is 2.53% per annum. Think about the opportunity cost there to you as an investor. That's absolutely huge. And so imagine that compounding for you. The opportunity cost is astronomical. So hence why John Bogle's comments there. Instead, we tend to focus on costs. So what we do here is get our, and I'll go through our exact process shortly. We get the asset classes that we want to invest in. We figure out the percentages that we want to hold in those asset classes. We then find the passive option to invest in those asset classes. And then we find the lowest cost of those passive options. And I'll actually walk through step by step how we assess those shortly. So focusing on fees is a much, much better way for you guys rather than focusing on performance. Now, just a real quick one. There is a time and place. I'm going to talk about ETFs a lot now, but there is a time and place for managed funds. Managed funds are appropriate for people when they're looking at illiquid markets and asset classes, such as private equity or alternative assets. Like I know you can invest in things like water rights, agriculture, those types of things out there. You cannot get these in an ETF. And ETFs are not suitable for things that aren't highly liquid. The ASX has actual listing rules, and those listing rules state that you've got to have a certain amount of liquidity available in the assets that you're holding. So therefore, small cap, you'll find a lot of small cap funds. You won't find too many small cap ETFs at all on the market. And that's because of those ASX listing liquidity rules.
Yep.
So there is a time and place if you're looking if you're doing a core and satellite investment approach in your portfolio and you're wanting an allocation to small caps. Essentially, one of the only way is to either handpick a few small caps yourself or invest in a managed fund that does that for you. Right. So how do you select a fund? Now, I've written down here, aim to be average. And by aiming to actually be average, you'll outperform most investors and most professional investors, which sounds weird. But I've pulled out a quote here from Morgan Housel, which when I read his book, The Psychology of Money, to me, this quote was, when it came to investing and when it came to a lot of people that I speak with and we deal with day to day here at InvestSMART, really stood out to me. He said, I can afford not to be the best investor in the world, but I can't afford to be the worst. So that's really, and so when people are, looking at those funds that are doing the 20, 30, 40% 1 year or ordering by performance and jumping in those highest performers, they're trying to jump on that moving train and be these are the best investors in the world. Focusing on not being the worst is actually a really, really great way to position your portfolio. And so how do you actually do that? Well, we go down and we look at ETFs. So here at InvestSMART, our investment approach is actually all built around the flaws in the investment landscape that we see. And so we actually only invest in ETFs here at InvestSMART. And so how we choose them, as I mentioned, we get them and you can actually jump onto the InvestSMART website. There is an ETF filter tool where you can do a lot of this filtering yourself. So we select by asset class. So does this particular ETF give me the exposure that I'm looking for? The fees, what is the total cost to you as an investor? So that's the MER in the case of an ETF. So that's the management expense ratio. So look at that. Look for those words when assessing an ETF. Size and liquidity. So are you easily able to transact? So for example, right now, I won't say which one it is, but there's an ETF we are looking at to bring into our portfolios right now with InvestSMART. It's relatively new. And so we're waiting for it to have more funds under management in that ETF before bringing it into the portfolio. So we don't think that's too far away, but size and liquidity does matter. That's how our ease of ability to transact. So when you're transacting in an ETF, there's actually 3 layers of liquidity. So the top layer is say if Tom and I both, if I held an ETF and Tom was looking to buy the same one, that first layer of liquidity is me and him just selling shares on market to each other.
Yep.
The second layer of liquidity is via the market maker. And then the third layer of liquidity is the actual holdings themselves. So an ETF has those 3. We like to see nice, big, fat ETFs, so to speak. So we've got plenty of ease of transaction. Now, performance. That's a funny one to have there when it's a passive investment. So it's going to track the benchmark. But when we say performance, what we mean here is, does it do what it says it's going to do?
And there's a really good question that Carrie's just popped up as well. Just saying, do we sit there and look at the quality of the underlying investments? We look at, because we're passive, we don't sit there and say, go into that much, do we?
Well, when we look at we look at the exposure we want to get, and we go from there. So if because we're looking at passive index tracking ETFs, so for example, our Australian equity exposure is going to be ASX 200. Yep. So it's the 200 largest companies in Australia. We're not finding an actively managed ETF, for example, that only holds 20 companies. That's when we would be looking at the companies. We'd be looking at the manager and scrutinizing them and their investment process a lot more. But when we're using an index tracking ETF like the ASX 200, IOZ, which is an iShares ETF that we use here, we don't look. We don't go down to that granular level.
No, so we basically want it to hold the top 200 Australian companies that Standard & Poor's, S&P, in the index themselves are covering, are tracking. And we say we want that exposure. I think the Australian market is at the ASX 200's like 9% total return for the last 30 years on average.
Oh, it goes back even longer than that. Yeah. So I think it's hovering around 8 to 9%, depending on what the figures that you look at there. And so we want that exposure, that long-term average. So back onto the performance. How closely does an ETF track its index? So there's a few things that will hurt, that will hamper an ETF from tracking the index. One, fees, of course. So an index doesn't have any fees. And as soon as you start to apply those layer of expenses, an ETF, if everything's perfect, will underperform the benchmark by its fees. There is then tracking error. So ETFs have to physically go out and purchase the underlying holdings, whereas an index, it's just literally getting an eraser, deleting one name, putting in another. ETF managers have to go out and buy these holdings when they come into the fund, into the index. So there's those actual transactions and transaction costs. And then finally, there's another thing that's, I think, called cash drag. So what cash drag is these ETFs are actually holding all of these companies, right? And so these companies all pay dividends at different times of the year. And so that cash will actually sit in the ETF until it pays it out as a distribution. So they pay them out quarterly, generally speaking. So of course, the indices don't have that burden of having that cash. So that cash can help or hinder an ETF's performance depending on versus the benchmark, depending on what the benchmark does. Finally, these last two are in the same category: location/tax. Where is the fund domiciled? Now, these days, you won't actually find too many ETFs on the Australian market that are domiciled overseas. I know iShares, for example, a few years back, made a big effort to actually re-domicile their ETFs and brought them all back to Australia. So why that's important is because if it's an international ETF, you want it domiciled in Australia to have to avoid any of the messy US tax implications and things like that.
All the forms, the WA bans, etc.
Et cetera, et cetera. You want to avoid those. We want to avoid those because they're very confusing. So where an ETF is domiciled is really important to us. As I said, this day and age, hundreds of ETFs available in the Australian market. There's not too many reasons why we'd look outside of an Australian domiciled ETF.
There's also the InvestSMART Bootcamp there too, which is a course that we run through InvestSMART. And I can see a lot of names that have signed up for the webinar have actually done it before. So hopefully that has helped. But it does take you through step-by-step explaining different terms like passively invested, actively invested, talking about psychology, talking about ETFs, how they work. And you can sign up on our website. It's $49.50 and you get 1 month complimentary access to Intelligent Investor and Eureka Report. And there's also a brand new InvestSMART for Business as well, where we can offer bigger memberships to different companies.
That's a plug there because Tom actually runs that.
I do. I run
that. So what the bootcamp will actually do as well, I'm running racing through this quite a bit because I do want to get to your questions and we do want to keep this to a relatively tight time slot. But Tom's Bootcamp really breaks down what we're talking about here, how we actually select ETFs in much greater detail, so you can go out there and do it yourself, really. So the next step, and I love putting this quote up here from Harry Markowitz. Harry Markowitz actually died a couple of weeks ago at the ripe old age of 90-something, 95, I think. Good innings from Harry.
He's well diversified. Yeah.
And Harry Markowitz essentially was a Nobel-winning economist, Nobel Prize-winning economist, and he developed what we now all use in the industry, which is modern portfolio theory, which translates basically into the saying, don't put all your eggs in one basket and diversify. So Harry actually proved that you could diversify across multiple asset classes and still have a without hindering your return too much. So he really hit the nail on the head with that risk and return with his different portfolios that he was able to put together. So that's what we do here specifically. We find we find the ETFs that we want to use. We then get our investment committee sets the weight. So the exact portion of how much Australian shares, how much property, infrastructure, bonds, cash, international shares, etc. And then we blend them together. And so Harry also came up with the efficient frontier. Basically, the efficient frontier, putting it in very blunt terms, is the blend of those growth and defensive assets as to not impact your portfolio's return. So it's that risk and reward. So you can see here how we have our portfolios diversified. I've got our conservative, balanced growth and high growth up there, and you can see how the high growth is essentially almost a mirror image of the conservative. They all hold the exact same assets. So our conservative portfolio holds the same assets as our high growth portfolio. It's the blend and the mixture of those that are different. Now, if you ever did actually just want to go and see what we hold. We're quite transparent. You just jump on the InvestSMART website, go to the investment portfolio section, and then you're going to do that live, Tom?
I can do this live
Okay.
and see how we go. I'm going to share my screen. Thanks for the warning. And I'm going to say, here we go. Yes, please.
I didn't expect this.
Look, it's all, you know, so do you want to choose the high growth?
Just go the growth. Go the growth.
Growth. Yeah, it's your favorite one, isn't it? So we scroll down to
scroll on down there. It's under key facts. Yep. And we've got asset allocation and holdings. So you can see here the exact asset allocation that we have to Australian equities, international equities, property, infrastructure, bonds, and cash. And then you can see the ETFs on the right-hand side that we use. So for cash, we use the Beta Shares Australian High Interest Cash ETF. AAA is the stock code. You'll often hear us refer to these by the stock codes. We'll quite often just abbreviate. Then we've got the iShares Core Composite Bond ETF, which is essentially Australian government bonds. We've got the VAN Global Infrastructure, iShares S&P ASX 200, Vanguard Australian Property, Vanguard Global Aggregate Bond, and then the Vanguard MSCI International Shares Index ETF. So essentially, these seven? These 7 ETFs go together to blend together to create our portfolios.
So just to compare, that's the growth, and we went to say the conservative. It's the exact same.
Oh, it's actually one other ETF in here. No, there's not.
No, I think it's all changed now. Just each of the diversified ones just hold the 7.
Yep. Perfect.
But you can see how the actual mix, the weighting has changed. It's a big chunk there at the bottom to fixed interest.
Fixed interest, which is so bonds and cash.
Yep.
So we'll jump back to the presentation there now, Tom. Now, once you've put all this together, the final hurdle, and one of the biggest hurdles that people find, even though you might have done all of this work. So we were focusing on the underperformance of your funds, but it's the actual investors as well themselves that cause their own underperformance. So there's a study in the US done by a research house called Dalbar. Every single year they release this, and I think it's actually the most important study. They've been doing this for 30 years that I read about investing, and it's actually 68% of investors underperform the funds they're actually invested in. So how does that work? So even though you're invested in a fund, your return for 68% of people is worse than the fund that you're actually in. And that's not the funds. It's not what the problem that the fund does. It's the actual what the investors do when they're going through the, different investment cycles in the market and emotional cycles that come with that. And so investors are more likely, and this study proves it, are more likely to top up when their stocks are high and they're feeling great about investing. And they're more likely to pull out of the fund when things are low.
Yep.
So essentially, instead of buying low, selling high, most investors do the exact opposite of that. So keep that in mind. We've got on our website, we've got a lot of psychological tips of trying to help people stay on track. But essentially, it's about creating a plan of your investment strategy, knowing and sticking with that plan. Let's finally jumping down here. So what we do, we've actually built our own investment service. I know I've already spoken about it a lot through this, so I'll just be really quick about this. We have built our own investment platform, the InvestSMART professionally managed accounts, understanding the shortfalls of the funds management industry. We know having really low fees are incredibly important. So we've decided to actually cap our fees. Okay, so we can do this because everyone's not in the same pooled investment vehicle. Everyone's got their own individual accounts, so we can cap fees on that. And we also don't have any like third parties like custodians and things like that who are charging us a percentage-based fee. So by having people in their own accounts and their investments on their own HINs, which is great for security, we can actually have that fee capped at $550 per annum. And the power of that is when you exceed that cap, the actual percentage, your fee as a percentage decreases. And if you're out there investing meaningful amounts of money into funds, have a think about what that cap would mean to you. That is more money going to growing your portfolio. It's more money get into earning dividends for your retirement. So we then understand that most active fund managers underperform the industry standard benchmarks. So we're just going out there and to get that industry standard. So we're going to use passive investments to do that. And then we want to be diversified because we never know what's around the corner, thanks to Harry Markowitz. We want to diversify across asset classes and within asset classes. And then we want to set up automation to help keep people on track with their investment plans. And that's automation for people contributing to their portfolios, to people withdrawing from their portfolios, to people living off the dividends, etc. We want to automate that and to help keep people on track as best we can. So that's looking at that's the fees, that's the passive nature that John Bogle had spoken about throughout this presentation. It's the diversification with Harry Markowitz. And then it's also trying to attack that Dalbar study to help give people the right investment habits. Okay, so that's basically all I've prepared. I've banged on for a while now, but you can get in touch with me directly. My email address is m.sneddon@investsmart.com.au. You can get in touch with me and the team at invest@investsmart.com.au. And you can also get in touch with us by using the on-site chat. So I know myself, Tom, other Mitch, Daisy, and Phoebe. We all man that chat, and so you can actually talk to us directly. Now, Tom, I was getting distracted during that presentation with a lot of questions coming through. Was there any questions that you wanted to tackle?
There are some excellent questions, and thanks so much for being patient. So I might go back to the very start because there's some good ones. And we will be attaching the meeting slides, the actual presentation. We'll do an article on the website and we'll pop that up there so you can download them directly in case you want to go through them. There was an interesting question talking about, let's have a look. Sorry about this. I just find there was actually quite a few. And this is a really good one from Sarah. I enjoyed this one because if you go back to that slide that we had at the very start, talking about, for this example, and if you go to the website, you'll look at how InvestSMART funds, you take, look at the different figures and you come to the conclusion that, well, InvestSMART also underperforms the benchmark over the long term. And this is correct.
That's right, yeah.
We're trying to follow the benchmark. We want to try and give you the benchmark, but unfortunately, it's impossible because there's fees involved and those other
there's cost to running the portfolio, and our goal here at InvestSMART, and we think slightly differently to a lot of fund managers and asset managers out there. When we compare our returns, and you're on our website, you'll often see us and often hear us talk about comparing our return to peers, because the peer group is what you can actually get. You can go out there and invest in other managers. You can't just, in a lot of instances, you can't just go out there and get the specific benchmark.
Yep.
So what we're attempting to do here is manage the risk of our portfolio. So our investment committee, so you might be familiar with some names on there. Our chairman of the investment committee and chairman of the InvestSMART group is Paul Clitheroe. Alan Kohler sits on our investment committee. Effie Zahos sits on it. Our CEO, Ron Hodge, our head of funds management, Alistair Davidson, and then people like myself, Evan Lucas, and our traders all report into that committee. They look to rebalance. They assess our portfolios every quarter and look to rebalance those portfolios on a quarterly basis, but rebalance them in line with risk. So they're always trying to have the portfolios basically having the right blend of risk assets depending on each portfolio's mandate. But also we're attempting to outperform the average of our peers. So we want to attempt to, if we do the same thing as our peer group, if we do the same thing as our benchmark, we are essentially going to underperform the benchmark by the cost of our fees, but outperform the peer group by the differential in our fees. And when you, over 1 year, that could be 0.5% or 0.3%. It may not seem like a big difference, but over 2 years, 3 years, 4 years, 5 years, when it starts to compound, as Tom's showing us here in our conservative portfolio, that's when you really see the difference in our structure. So it's not us active, like we're managing for risk, the asset classes in the portfolios. We're not managing to try and, time the next leg up a specific asset class. We're managing for risk, and we're letting our advantages on cost and the passive nature of our investments to exceed our peer group. So that's what we're attempting to do there. But thank you. It's a really
it's a great question. There's another one just talking about how do I find the benchmark. At least on our product pages, we do list it for each one. So for example, note our InvestSMART Conservative is benchmarked against Morningstar, where a lot of our data comes from. That's their Australian moderate target allocation in Aussie dollars. I'll just see
what else have we got there, Tom?
We've got, just stop my screen and have Bass back. There was an email, and this is a very good question too, because I guess it's something that InvestSMART Group, we have a number of different brands. We've got InvestSMART, Intelligent Investor, yes, Eureka Report.
Yes.
And Grant's pointing out that, comparing your passively managed investments, so the InvestSMART capped fee diversified portfolios and the single asset class portfolios, they're passive. So we're not trying to beat or outperform the market. We're just looking to get the industry benchmark, the industry return, less any fees. So there's pretty much the two schools of thought. So the Intelligent Investor team, they are out there saying, we think that our value investing approach can beat the market, invest with us, and we're going to try and beat the market. Our fees are a little bit higher than they're uncapped for a start. Whereas the InvestSMART funds management's looking at, over the long term, passive approach, low fees, and we believe that you'll be better off. Now, those are the two schools of thought, and we talk about this in boot camp, where we talk about how one will say one's better, one's worse, etc. Why not have a mixture of both? That's what we try to say as well. Is a core and satellite approach is a very popular strategy. At the core, like the planet Earth, you've got a passive investment that just ticks along. It's nothing fancy, just gets the industry return.
It does what it says it's going to do on the label.
That's it. And it's off the shelf, really, isn't it? Like the shopping metaphors and stuff. But and then you've got on the satellites, you might have a managed fund, you might have an intelligent investor, ETF, or a combination, even inside the InvestSMART PMAs.
Yeah, Grant, it's a really great question. People will often point out to us, you guys do talk about managed funds not beating the industry standard benchmarks, and it's true. We do talk about that a lot. Over on in our group, we do have the Intelligent Investor. Now, the Intelligent Investor is a subscription service where they put buy, hold, and sell recommendations on Australian stocks. Has existed for almost 25 years now. That was founded by John Addis, who's still with the group today. They do have 4 managed funds that are listed on the Australian Stock Exchange that people can go out there and purchase. So far, those 4 funds do outperform their benchmarks that they're trying to exceed. But this team have got 20 odd plus years of a background of outperformance. You won't find too many fund managers out there with that. Now, that doesn't mean that they're going to outperform going forward, because we do not know what's around the corner. But essentially, and they do have low costs compared to a lot of other investment options out there. But these guys have been running model portfolios for almost 20 odd years as well. So they've got a very long track record, which is, if we're looking at active investments, we'd be looking for a long track record of outperformance. We would be, even though past performance doesn't guarantee future performance, we'd be looking for an investment approach that sits comfortably with us. So one that we understand. That's something that I look for when I look for an actively managed fund. I've got to understand the investment approach and what they're investing in and why they're investing in it. And so just so I can hold that fund through the good times and bad. And then look for active share as well. So active share essentially means if I'm investing in a managed fund and I'm paying active fees for a stock picker to pick good stocks, I want them to actually be doing something different from the market. That's what I'm paying them for. So active share is how different the difference between the fund's holdings and the benchmark holdings. So you actually should want this fund to perform, and that'll mean sometimes it'll be far worse than the benchmark, but that'll also mean it'll exceed the benchmark as well, or it gives itself a chance to, at least. So yeah, there's room in a portfolio for both. And that's called a core and satellite approach. And I know a lot of our investors, and with our InvestSMART diversified portfolios, in our accounts, people can also hold those intelligent investor funds inside their accounts. So that's something that people do with us here when doing a core and satellite approach.
There's a couple of questions coming through. I'll try to answer some, but even Mark's just pointing out there, is there a super option for the individual investor? So we're not a super fund. We're not a registered super fund. So we can't actually let you choose that through that process. You have to have your own self-managed super fund set up, and then you can do that. So if you come to us as an SMSF, you can then decide to invest into the different portfolios. One of the latest trends, and we spoke about this last webinar, was talking about how people are starting to invest just outside of super as well, and there's a different tax environment, so definitely do the research. But particularly as the retirement age is also getting pushed out, some people might need that to be held outside.
So with our InvestSMART professionally managed accounts, we have account options for individuals, joint investors, individuals with kids, so on behalf of children, family trusts, companies, and SMSFs. So if you're confused, though, if you're going down that path, which application form do you choose? Please reach out to our little chat bot, and one of our team will jump on and help you out.
There's just a couple of questions coming through about the fees, and that's always a good question. And this is something that even in InvestSMART Bootcamp, we really make the point that you should do your research, find out about the fees. As Mitch mentioned, for the InvestSMART capped fees, it starts off at 0.55%, and then as soon as you go over $100,000, that's the ceiling. It caps out. So you could put, if you're lucky enough to have $200,000. You'd still only pay us $550 per year. I was just going to say also that it's on a per account basis. So you can have one account, which we call a professionally managed account, another acronym, PMA, and inside it you could have a number of different portfolios, but we just charge that fee to the actual account itself.
And just on that note, so that's a really good selling point of ours, that you can have, for example, the InvestSMART Balance portfolio and the InvestSMART Growth portfolio. As I mentioned before, though, they do all hold the same ETFs, so you're not getting greater diversification, but you're just getting two different risk profiles. And that might be, and so we don't recommend people just go out there and hold, 3, 4, 5 just for the sake of diversification. If you're coming to us with an actual investment strategy, sorry, and your plan is to have, say, a shorter term portfolio and a longer term portfolio for future growth, you can have both of those in the one account. We'd recommend taking a look at the time frames. Every single one of our portfolios has a time frame attached to it, and that'll actually tell you a lot about the risk that the portfolio is taking as well. So do have a look at those when selecting the portfolios.
I was just answering a question there while you were losing your voice. Just saying that that with even, we have that cost, the fee that InvestSMART charges, and what we do with that is we make sure that your investment, your portfolio stays in line with the risk that you've chosen from the start. So if you've chosen growth or even ethical growth, which we've left out of this presentation, but it is there. Sorry about that. You want to make sure that you've chosen that risk profile and you want us to stick to it as close as we can as it progresses. So if some assets go up, some go down, which does happen, we rebalance and we make sure that it stays within those percentages. And the percentages can change. The benchmark might change slightly. Our investment committee meets every quarter to decide, should we do this or that to follow the benchmark. But yeah, we hold each ETF, so like BlackRock runs the iShares, there's Vanguard, there's VanEck, there's BetaShares, and they all charge their management expense ratio, their own little fee. And that's the same as if you're holding it yourself. So you can go out, like we've shown you, all the ETFs that we've listed on each portfolio. You could go to your share broker and you could buy each one. Our CEO, Ron Hodge, makes a point of saying, like, if you think that you can do this, that's liberating, excellent. If you don't have the time or the know-how or even the rebalancing, doing the tax statements, that's what we do. We do for you. Yeah.
So for a small cost, we handpick the ETFs, we rebalance them, we monitor for new ones coming out onto the market. As I mentioned, we're looking to make a change currently, but we're just waiting for this ETF to get larger before we do bring it into our portfolios. So we're constantly monitoring what's coming up on the horizon for you as part of that service. So yeah. Now we've got a question there from Liam wondering if margin loans can be used. People can't take out a margin loan and then invest in our products. So you can't go and get a margin loan, say with CommSec or leveraged equities, etc., and then invest in our portfolios, because the margin lender would like to hold those assets. But we have a service called Fund Later, where essentially the investor, it's to help investors, younger investors who are coming along looking to get into the market. It essentially helps you get to that $10,000 minimum investment and also build good investment habits. So you front up with $4,000, InvestSMART loans you $6,000, and then you repay that on a monthly repayment schedule. And so once your loan has been repaid, it's a non-recourse loan as well, so you can walk away from that at any point in time. Once that loan has been repaid, you can now actually top up with an additional $6,000, or you can continue on with your that savings plan that you got in place, adding those repayments to your account that go to then buying shares and building your account.
Question there from Martin: does InvestSMART collate and send out the end of financial year paperwork? We do. It's a question that we're asked, I guess, a lot around this time of the year. It's usually a bit in September, just because some of the holdings take a little bit longer to report. It's a really interesting note. Like we are trying to make the point that we do all that for you. You get rid of the paperwork. That's basically what you're paying us the fee to do all this and handle it for you. So if you're someone who is too busy, even if you want that set and forget approach, that's completely, it's fine and it works with us.
Yeah.
We've reached, I guess, the end of the webinar, but we're looking to do more of these. We're going to do some more coming up next month as well. We're always happy to get feedback. So if you do have any questions, definitely reach out to us. I'll just put up our details again, and you can email at investsmart.com.au and ask us any kind of questions. But until then, thank you so much for attending. And yeah, we'll see you next time.
Thanks, Tom.